Hello and welcome to the seventh episode of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. In this podcast, we'll dive into the latest M&A activity, upcoming spin-offs, significant buybacks, unique insider buying, activist campaigns, and a whole lot more.
My name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
And my name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area. This week, we will briefly cover Bill Ackman's updated proposal to acquire Howard Hughes, two competing offers for existing deals, with one of them resulting in a superior offer that the company accepted, the spinoff of Milrose Properties from Lennar, the insider sale at JPMorgan by Jamie Dimon, and other insiders as well, and management transitions at multiple energy companies.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
So, before we begin this podcast, I want to put in a word for our latest upgrade on the Inside Arbitrage website, which is the AI chat feature that you can find in every quote page on the site. So, we are now using Perplexity Sonar as the default AI model for the chat. One of the issues we were running into with older LLM models was that they would not crawl the web for current information and were limited to when the model was last trained. Perplexity, as you and I both know, does a great job of combining the trained model output with real-time web crawling to get the most recent information. We upgraded the three LLM models we have on our AI chat feature to the latest ones, and then we also added Perplexity Sonar. So the AI feature now for Inside Arbitrage Plus and Premium members allows them to actually ask questions to all four models simultaneously. I've personally been enjoying using this feature, and I'm hoping that all our subscribers find it quite useful as well.
Let's kick this podcast off with a pre-deal, or as we like to call it, deals in the works situation. Last week, Bill Ackman unveiled Pershing Square's updated proposal for Howard Hughes, and this new proposal was met with a lot of criticism from investors. Before we get into the details of the proposal, let's briefly touch upon what Howard Hughes does and the structure of the original proposal that Bill Ackman unveiled on Twitter on January 13th of this year. We discussed Howard Hughes and that offer almost exactly a month ago in our second podcast episode. Howard Hughes is a real estate development company, but isn't structured as a REIT. It typically builds master planned communities and also sells condos in Hawaii.
As we mentioned in that episode, I met with the SVP from Howard Hughes in San Francisco before their Seaport Entertainment spinoff. And we've been following this company since, I think, November 2022, when we noticed a big uptake of insider purchases of the company by Pershing Square. In his initial offer, Bill Ackman revealed that Pershing Square held a position in Howard Hughes since its spinoff from General Growth Properties in 2010, and over a 14-year period, the returns on the investment through August 6, 2024 was just 35%, or 2.2% compounded annual returns. Now, that's not very exciting returns, and I can see why Bill Ackman is trying to generate some interest in the company, either by increasing a stake or getting other companies to participate in buying Howard Hughes. So this performance of 35% also includes the impact of the Seaport Entertainment spinoff. The initial offer he had for the company was $85 per share, with Pershing Square acquiring 11.76 million shares from the public shareholders for about $1 billion. Pershing Square at that time held 37.6% of Howard Hughes, and public shareholders had 62.4%. At the same time, they suggested that Howard Hughes should consider buying back $500 million worth of their own stock by taking on debt.
Following the cash or stock transaction, it was expected that Pershing Square would own between 61% and 69% of Howard Hughes, depending on how many public shareholders elected to receive cash and how many rolled over their stock into the new incarnation of Howard Hughes, which would have been created by merging Howard Hughes into a newly created subsidiary of Pershing Square. So, a very, very complicated transaction there. The two odd things about this transaction were that even though Pershing Square would have owned that 61 to 69% of the company, they agreed to restrict their voting rights to less than 50%. Pershing Square also wanted to charge a management fee of 1.5% of Howard Hughes' market cap to Howard Hughes. Shareholders were neither happy about the 1.5% management fee, understandably, nor the fact that the cash offer of $85 per share was well below the last estimated NAV of the $118 per share.
Yeah, so I was quite excited to see what the final offer might look like, or if we might see somebody like Blackstone stepping in with another competing offer. This new offer threw everyone off. So this new offer, in contrast, is almost completely different. Instead of Pershing Square buying shares from the public shareholders, they would now buy 10 million shares that are newly issued by Howard Hughes for $90 per share, or for basically $900 million. There would be no share repurchase component. And after the transaction, Pershing Square's stake would increase to 48%. The 1.5% management fee that everybody was not a fan of remained in the new offer.
Now, the long-term goal appears to be to create something similar to Berkshire Hathaway, but there's nothing Berkshire-esque about this offer. Shareholders are not required to vote on the offer, but they are in many ways doing so by abandoning the stock. The stock ran up by nearly 7% last Tuesday in anticipation of this offer when Bill Ackman mentioned it on X during market hours, only to drop 9% the next day when the details of the offer were finally revealed.
Professor Paul Neri, who teaches a course on corporate development, mergers and acquisition in the Wharton MBA program, posted an excellent assessment of the situation on X last week. I won't get into all the questions he posed and attempted to answer, but I can touch upon why Howard Hughes converting to a REIT structure is not an option. I asked Howard Hughes the question about converting to a REIT structure, and the response I received from the company was that they would get classified as a diversified REIT, and those diversified REITs generally tend to trade at a discount to pure play REITs. Diversified REITs, as you know, have a portfolio of properties that can be a mix of office, retail, apartments, and more. We own a diversified REIT called American Assets Trust in our portfolio that has done well for us, but that could simply be because we got into it at a good time when diversified REITs with exposure to office real estate were in a tough spot, and we noticed insider buying of American Assets Trust by its founder. I think he was over 80 years old at that point, and he was buying on very consistently, and it would show up in our Form 4 filing reviews every night. I decided to take a look at how diversified REITs are currently valued in the public markets, and here is what I found. The key metric I'm going to focus on is price by AFFO, where the AFFO stands for Adjusted Funds from Operations. I know this is probably not a good direction for the podcast to go. I've been told by people who've written books that as soon as you introduce a formula in a book, you're going to lose the reader. And here we are going to be talking about REIT ratios. Anyways, the AFFO stands for Adjusted Funds from Operations. And because REITs have large depreciation expenses, they often buy and sell real estate, the price per AFFO metric is often more appropriate than using something like P by E or even EV by EBITDA. There are 18 REITs classified as diversified REITs according to NAREIT, which is the organization that provides excellent REIT data that I use periodically when analyzing REITs. 5 of those did not have any price per AFFO data, and most of those 5 are microcap companies. So for the rest of the REITs, the 13 that were left, they trade at an average price per AFFO of 10.24, and this is trailing AFFO, and an average price per AFFO forward of 12.92. So think of them like, about 10 times trailing AFFO and 13 times forward AFFO. The median numbers for these 13 REITs are very close as well. But the range, however, is very large. So you have something like Peakstone Realty Trust trading at a trailing price per AFFO of 3.71, and Hawaii-based Alexander and Baldwin trading at 16.6 times trailing AFFO. The next time we are in Honolulu, we should go check out some of the properties of Alexander and Baldwin.
Yeah, so building off of that, Howard Hughes generated nearly $160 million in operating cash flow over the last 12 months. While we don't have adjusted funds from operations, we can use operating cash flow as a proxy. This gives us a price by FFO of 23 for Howard Hughes. Howard Hughes' decision to not convert to a REIT structure does hold water, as their valuation would be immediately cut in half if they are valued like a diversified REIT. When you think about the discount to NAV on their properties, you can also see that hotel REITs like Pebblebrook Hotel, which we've discussed in previous podcast episodes, also is trading at a big discount to NAV, which means that converting to a REIT structure doesn't necessarily help with narrowing the discount to NAV.
Let's see how this whole situation plays out in the public markets in the coming weeks. Moving on from this Howard Hughes situation, let us briefly discuss two deals where they received a higher offer. A lot of investors who are new to merger arbitrage only focus on the big headline deals that fall apart. Like the Spirit Airlines deal that fell apart or Capri. They don't realize that 90 to 95% of all announced M&A transactions close successfully, and some of them even receive higher offers. And so the deals that receive higher offers generally tend to offset, not entirely, but to some extent, the losses from the failed deals. We saw two of these offers last week, where H&E Equipment Services received a competing offer from Herc Holdings for $104.59 per share in a cash and stock transaction.
United Rentals, which was in a $92 per share all-cash deal to acquire H&E Equipment Services, immediately decided not to get into a bidding war. They no longer wanted to play, took their marbles, and went home. The marbles that we're referring to here are the $63 million of a termination fee that H&E has to pay United Rentals because they deemed the Herc Holdings offer to be a superior proposal and accepted it. The spread on this new deal is less than 2%, even though it is a cash plus stock deal. The spread on the United Rentals all-cash deal was actually higher, reflecting regulatory concerns with that deal.
The second company to receive a higher offer last week was the clinical stage biotech company Acelerin. I'm sure I butchered that name, but let's stick with it, which was in an all-stock deal with another biotech company, Alubis. The deal price worked out to $2.20 per share before Concentra Biosciences came swooping in with a $3 per share all-cash offer. Not only are they willing to pay a whole lot more, the non-binding proposal also includes a contingent value right or CVR. This non-binding offer expires on February 27th, and Acelerin has not yet accepted this offer as a superior proposal. It is actually currently trading at $2.60 per share. So if the offer is accepted, you have some pretty significant upside there, up to $3 per share, just in the cash component of the deal, and then some additional CVR value if it pays out.
Yeah, CVRs are a great way to get a little bit of a bonus on top of an existing M&A deal. So speaking of these CVRs, one of the new deals announced last week had an upside down CVR. This is a situation where the value of the CVR is much higher than the cash price of the deal. In this case, Carlyle and SK Capital Partners are paying $3 per share in cash for Bluebird Bio, and the deal includes a contingent value right of $6.84 in cash if Bluebird's current product portfolio achieves $600 million in net sales in any 12-month trailing period by December 31st, 2027. The stock is trading right now at $4.80.
I believe it's $4.08, but that whole thing was a mouthful, especially as it is with CVRs and the milestones that are attached to them. At least this is a simple milestone deal. There are some where there are multiple milestones with different dates and different probabilities assigned. Anyways, I remember this company, Bluebird Bio, because several years ago, I met a friend who works in cancer immunology for coffee, and he mentioned three companies to me. One of them was Kite Pharmaceuticals, which Gilead acquired for $11.9 billion dollars in 2017. The second one was actually Bluebird Bio. When this deal was announced, I looked at the stock's price chart and noticed that it had lost 99% of its value in the last 5 years. And the market cap is now just $40 million. dollars. Before you ask me, I can't remember the name of the third company you mentioned because this conversation happened almost a decade ago.
You may have forgotten the name of the third company, but you probably won't forget the third new deal announced this week, which was the acquisition of Global Blue in an all cash deal worth $2.5 billion by Shift4 Payments. Shift4 Payments was founded by Jared Isaacman, who is now known for flying fighter jets, paying to go to space, and more recently for being tapped by the Trump administration to head NASA. We actually wrote about Shift4 Payments last year. Following some very well timed insider purchases by Jared Isaacman, the stock has performed quite well since those purchases.
This was another reminder for me to pay attention to the person buying the company, not necessarily just the company. And this was one that we missed. We should have bought some stock after he did. Anyway, switching from insider transactions and the new deals, let's talk about spin-offs for a bit. On the spin-off front, we saw Milrose Properties was spun out of the home builder Lennar last week. Milrose Properties is a company that acquires land on behalf of home builders and gets home sites ready for construction. Once they do that, the home site is sold to the builder and they start construction.
Joel Greenblatt told us to pay attention to how incentives were structured for insiders in a spinoff. We took that one step further and track insider buying in spinoffs in a custom screen that we call the Spinsider. We noticed a cluster of insiders buy stock in Milrose Properties after the spinoff, including the CEO, COO, and two directors.
This very much reminds me of insider behavior in two other spin offs, including the spin off of Vitesse Energy from Jeffries, which I had because I used to own Jeffries, and Biohaven from the old Biohaven, which was acquired by Pfizer. So this is a merger arbitrage situation with a spin off. And if you remember, there was an insider transaction by a director in that situation as well.
Another spin-off that is imminent is a SanDisk Flash division from Western Digital, which happens on February 24th, which will actually be the day that this podcast is released. The next day, on February 25th, SanDisk will join the S&P Small Cap 600 index prior to the start of trading.
I'm very curious to see how this plays out because we have a position in Western Digital and we've written about the spin-off multiple times, including appearing on Rich House podcast discussing Western Digital.
Let's switch gears slightly and move on to stock buybacks. Analog Devices, a global semiconductor company that designs and manufactures integrated circuits, just announced a $10 billion buyback, representing about 9% of their market cap. This new buyback adds to a prior share repurchase authorization, bringing the total remaining share repurchase authorization to approximately $11.5 billion. Aside from this massive buyback, though, the company doesn't look all that interesting. Our IA Quant score rates the company fairly low at 45, and you can kind of see why with the company's expensive valuation. Financials aren't all that exciting either. Both revenue and net income have been declining slightly over the last year and appear to be somewhat variable. Free cash flow, at least for Analog Devices, is a bit better than net income, so that looks promising, but overall, the buyback seems to be the most interesting part of the company.
Let's talk about another company which has been doing very well recently and also announced a buyback. Unum Group, a large insurance provider that we have personally used in the past, that specializes in disability insurance, also announced a large buyback of $1 billion or around 7% of their market cap at announcement. The stock is up 50% in the last year and up by over 150% in the last 5 years. Unum has been consistently buying back shares. They last announced a $1 billion buyback in July 2024 and have bought back 9% of shares outstanding over the last 4 years. However, with the announcement of this new share repurchase authorization, the prior buyback authorization has been terminated.
Moving on to yet another buyback announcement, Valmont Industries, which is a metal fabricator for the infrastructure and agriculture markets, just announced a $700 million buyback, which also represents about 9% of its market cap. Compared to analog devices, our IA score ranks Valmont a lot higher at 76, and it's easier to see why. The company managed to beat both top and bottom line estimates in Q4, and the stock is up around 60% in the last year, so there's a big momentum push there. Revenue growth is a little bit flat, but we've seen some recent jumps in free cash flow, which could be the reason as to why the company has started to pay down debt. The CEO looks quite experienced as well. He holds a CPA and joined the company as CFO in 2020 before assuming the role of CEO in 2023.
The next buyback caught my attention because this is a company I used to own more than 10 years ago when it was trading at just about $30 per share. It eventually went up to $300 per share, and I would have made 10 times my investment. So, you know what they say about buying something and just sitting tight and letting it do its job. The company is actually ICON, one of the world's largest clinical research organizations, better known as CROs. They just announced a $750 million buyback, representing almost 5% of their market cap. For those that are unfamiliar with CROs, they provide outsourced development and commercialization services for drug development companies. ICANN is down 35% in the last year, which could be due to the fact that the company has missed earnings estimates every single time in the last 4 quarters. Management might be seeing this as an opportunity to repurchase shares at a lower price, especially considering the company appears to be somewhat cheap with a forward P by E of 14.22.
Our last buyback announcement was a $500 million share repurchase authorization, representing about 10% of GXO Logistics' market cap. The company's stock price has been beaten down quite badly over the last couple months, especially after a rumor in October 2024 that the company was exploring a potential sale, a rumor that never quite came to fruition. GXO was spun out of the less than truckload logistics and shipping company XPO in 2021. If the name GXO sounds familiar, it might be because we've been talking about a hostile bid for Beacon Roofing Supply by QXO over the last couple podcast episodes. QXO, GXO, XPO, and more are all Brad Jacobs' companies, where he either serves as CEO and chairman.
You know what this reminds me of is Vivek Ramaswamy's companies, all of which end in Vance, Roy Vant, and so on and so forth. That's interesting. Let's talk about insiders for a little bit. So, moving on to insiders, we normally highlight notable insider purchases in this section since we find insider buying to be a much stronger signal when compared to insider selling. Insiders sell for a number of reasons, whether it be for tax purposes, to fund a large purchase like a new vacation home, or simply because they keep receiving RSUs and don't want to hold on to the excess stock. But generally speaking, insiders only tend to buy shares of a company for one reason. They believe the stock price will go up. And quite frankly, that is another reason. They know that you and I are paying attention to the purchases, and they might also buy to signal the market.
Occasionally, though, we come across a particularly notable sale, and we saw that this week when Chairman and CEO of JPMorgan Chase, Jamie Dimon, sold $233 million worth of the company's stock. JPMorgan has had an absolutely incredible year. In fact, all the major US banks have. JPM in particular made more annual profit than any lender in the history of American banking during fiscal 2024, an incredibly impressive feat. And as a result, JPM's stock price has run up by nearly 45% in the last year. Given this run up, I'm not all that surprised to see Jamie Dimon selling shares, and he wasn't alone in his sales either. We also saw the Chief Information Officer, Chief Operating Officer, Head of Human Resources, and the co-CEO of the Commercial Investment Bank sell shares this week.
These sales were all the more unsurprising considering that JPMorgan filed an 8K last month announcing that Mr. Dimon would be selling 1 million shares through a 10b5-1 trading plan established in November. So it's interesting to see that last year, I think he also sold shares, but this time around, because the price has appreciated so much, he sold a whole lot more.
JPM signaling this sale, like announcing it in advance of the sales actually coming through, actually reminds me of Jeff Bezos selling shares of Amazon. And when he was selling massive amounts of Amazon, also through a 10b5-1 trading plan, he had announced that he would be selling shares prior, kind of to make it seem like less of a signal to the market, less sudden. Moving on from this, though, I will say that the recent sales of JPM aren't the only thing that Jamie Dimon has been in the news for recently. There's been a lot of talk about removing COVID era policies of hybrid work or work from home across corporate America, and JPM is no exception. Jamie Dimon wrote a memo to all employees of the company stating that beginning in March, all employees would need to come into work 5 days per week. Jamie Dimon has been the CEO and chairman of JPMorgan since 2006, and it's probably these strict policies and practices that led to the company's success over the last few years, though we can see employees not being too happy about the change.
He's been an excellent banker and operator. He was slated to become the CEO of Citigroup, and thankfully for JP Morgan, that didn't happen. Moving on to another insider purchase, we saw the chief medical officer of the pharmaceutical giant Bristol Myers Squibb purchase shares. We always like to see chief medical officers of biotech or pharmaceutical companies purchase shares as they have a more technical, in this case, sciencey understanding of the company, especially of any potential drugs or medicines in development. This recent purchase adds to a 2024 purchase at a very similar share price.
In addition to the purchase by the chief medical officer, we also saw Bristol Myers Squibb's CEO purchase shares 6 days later. These purchases weren't all that large, only about $100,000 each, but we still thought that they were worth pointing out. I will say that Bristol Myers stock took a pretty big hit in June and July 2024, and I was surprised to see that no insiders purchased shares then, as that would have been the great opportunity to pick up stock. They only began to purchase after the stock had begun to recover, which is pretty atypical. We normally see insiders of companies purchase shares after a large drop in stock price, as they understand when the company is undervalued and take the opportunity to start building a bigger position.
The last purchase we want to briefly mention is Ruth Porat, the president and chief investment officer of Google, purchasing shares of the asset manager Blackstone. If you recollect, I mentioned to you that 2 years ago when I was at the Berkshire Hathaway meeting, a friend of mine mentioned to me, hey, look, that's Ruth Porat, the CFO of Google. So she used to be the CFO and now she's a chief investment officer. We were quite surprised to see this purchase come in at first, but after a quick look at the Form 4 filing, we noticed that the purchase was an automatic dividend reinvestment.
We were talking about purchases being notable signals earlier, but I wanted to bring that Ruth Porat purchase up since we tend to discount insiders that buy shares as a result of a dividend reinvestment simply because the process is automatic and the insider isn't actively seeking to acquire shares of the company.
As we like to say, transitioning to C-suite transitions, I was sorry to see that the CEO of the fracking company, Diamondback Energy, plans to step down after 13 years at the helm. This was one of the best managed energy companies, and I held a position in Diamondback Energy for several years before finally selling the stock last week based on this news and other factors related to where things are with the energy sector. During the 13 years Travis Tice was at the helm of Diamondback, the stock went up more than 1,000%. It is good to see that he will remain involved as the executive chairman through the company's 2026 shareholder meeting. I always found it amusing that they gave the companies that they spun out of Diamondback names of deadly snakes as well. Two of those spinoffs were called Viper Energy Partners and Rattler Midstream. So you have Diamondback, Viper, and Rattler.
Clearly a snake beam going on there.
Indeed.
Another C-suite departure in the energy sector was the CEO of the offshore drilling company Transocean announcing that he is leaving this summer. Jeremy Thigpen was the company's CEO for over 10 years. Performance during his tenure was not as good as Diamondback because the stock of Transocean was down by 80%. If you think frackers had it hard during the last decade, the offshore drilling services business went down a long downward spiral as crude oil prices kept dropping. Transocean COO Keelan Adamson is set to become the new CEO.
I still have brain damage from having owned Noble Energy during that period, during the last decade, when all the offshore drillers would constantly see their stock go down and they would cold stack their drill ships because there wasn't just enough demand for them. Moving on to another company that has caused a lot of brain damage to the meme stock investors, if you could call it that, is AMC, the movie theater company, where the general counsel suddenly departed. He was at the company for almost 18 years, and during that 18 years, the stock was down 98%. It is at $3.70 per share now. And at one point, on a split adjusted basis, it had gone up to $600 per share during the meme stock mania of 2021. This whole thing reminds me of that movie Dumb Money about Keith Gill, who's also more popularly known as Roaring Kitty, and what he did with GameStop.
Speaking of sudden departures, we also saw a sudden departure at Sealed Air, a mid-cap food safety and security company. The CEO, Patrick Kivitz, left his position after just 8 months, after having joined in July 2024. The current president and CFO, Dustin Seamack, is set to take over as CEO after Mr. Kivitz leaves. Mr. Seamack joined Sealed Air as CFO in March 2023, and in June 2024, briefly took over as interim president and co-CEO. These C-suite transitions at Sealed Air are honestly the tip of the iceberg, and as I'm looking over the data, we've seen almost a revolving door of various executives at the company, which does make the company's disappointing stock performance over the last year more understandable.
And this is such a boring business. And to see this revolving door of C suite executives at a boring business is actually quite fascinating. Makes the business more interesting in a negative way, if you will.
A little bit concerning.
Absolutely. Last but not least, the engineering solutions company Floor is facing a very similar story with lots of turmoil in the C suite level. Much like Transocean, this is another situation where the COO is set to take over as CEO. But despite only being in the role of COO for 9 months, James Brower has been with Floor for over 31 years. Floor also very recently appointed a new CFO and Chief Legal Officer.
And that wraps up our 7th episode of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool. Check out insidearbitrage.com.
And if you enjoyed this podcast as much as we enjoyed recording it today, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who might be interested in special situations. Thank you.